in your opinion, has Chairman Powell and his team, done a good job? Are there any risk that you see that is facing the Federal Reserve as we begin this rate cutting campaign?
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. My name is Matt Walters, and I'm with Lee Mackey.
Good morning.
We're excited to have a very special guest on the podcast this morning, AJ Nobile from JPMorgan. So before we get into that, as always, we want to encourage you to go out, like, subscribe, follow the podcast, the shorts, everything we're doing on YouTube. Really appreciate you guys checking in, following us, and helping us out there. And give us comments. We always love going through the various comments, and from time to time, we'll take some of those and make a podcast out of them.
Yeah.
So it always helps with some of the content side of things. So AJ Nobile from JPMorgan, happy to have you. You're coming to us from New York this morning, so we appreciate you jumping on here with us.
Of course. Thanks for having me. Excited to be here.
Yeah. So before we jump into some of the things we want to talk about today, give us a little bit of a just background on, who you are, maybe education, where you went to school, how you got to JPMorgan,
Sure.
and then what you're working on at JPMorgan now.
Sure. So AJ Noble, I've been with JPMorgan actually my entire career. So started as an intern in 2009. Prior to that, grew up in Pennsylvania, small town near Scranton, Wilkes-Barre, Pennsylvania. Went to the University of Pennsylvania, so go Quakers, and then started an internship with our short-term fixed income group, Global Liquidity, and that's really our arm that deals with cash, money market funds, and what we call the first step out of cash, ultra short. And my first couple of years was a rotational program, so I did some business management, I did some sales work, I did some marketing work, and then I settled into the team I'm with now, investment specialist team, investment strategist team within short-term fixed income. And essentially what we do is we communicate our group's views to clients, institutional and retail clients alike, across the country and across the globe. So I supported that team for a few years, 2013 to 16, and then started seeing clients in 2016. My group as investment specialist team, we have a firm understanding of money market funds and cash, but really our bread and butter is that ultra short space, which sits as the first step out of cash. So we manage a great deal of assets there for large institutions, separate in the form of separately managed accounts. We've been doing that for a couple decades, and then we really wanted to take that strategy that had a great deal of success to the retail audience, and we did that through an ETF called JPST, the Ultra Short Income ETF. So about 15 years with this group, and now manage our junior individuals on the team, and we've been continuing to grow. I mean, money market fund assets you see at all-time highs, and I think the same applies for ultra short assets, that first step out and call it the 0 to 2, 0 to 3 year space.
Yeah. Well, there's obviously, money market funds, short-term treasuries have been kind of the hot thing here in the last couple of years. No one talked about it for so long. I don't think I used the phrase or the term like CDs and money markets the entire first 15 years of my career. And then the last couple of years, it's like everybody wants some of it, right? Makes sense. So very cool. So JPST, is that the primary fund that you're involved with JPMorgan?
It is, yeah, it is. And it's actually the largest actively managed fixed income ETF. So it launched in 2017. And what we do with this fund is we take a conservative approach to the space. And that's really what differentiates JPST from other funds in this ultra short space. So ultra short, it's the first step out of money market funds. Morningstar defines it as an interest rate duration of 1 year or less. So pretty broad-based definition. Mm-hmm. So you get a wild west of different types of funds. And a lot of them are fixed income type funds, but you have all the way down the other side of the spectrum to treasury bill funds. And what we are is a money market instrument, corporate bond hybrid fund. And it's managed on our liquidity desk. So we take a lot of the conservative ideas that we have from our money market funds, and essentially we evolve them one step up the curve, things like a credit process, a risk management process, internal approved list. But yes, that's the main fund I work on. And then I also have in the neighborhood of 20, 25 separately managed accounts for large institutional clients, similar type mandates, but highly customized, where the institutions own all of these underlying bonds. They can sell the bonds into the market if they need cash. Essentially just a similar strategy, different type of vehicle.
Sure. Yeah. And full disclosure, we utilize JPST in our in-house ETF models. So fans of the fund, and it's been a good solution for us and our clients.
Well, thank you for that.
Yeah. Piggybacking off of something you said, you've used the term money market, quite a bit lately. This is different than a bank money market.
Sure.
How do clients, the retail client, how do clients use this particular type of strategy, this ultra short space in a portfolio?
That's a really great question. And I think to answer, I'll answer that question by starting with how we view money market funds and cash, because I think it's really important for clients to keep cash in a cash product, right? So keep your cash in a money market fund or a treasury bill roll strategy. And what we define cash as is if you need the cash in one day, a week, a month, okay, then it should be in a liquidity or cash product. That next step out, JPST, we view as something that is appropriate for 6 months and out, essentially. Right? So I think essentially the fund is designed for use in the 6 to 12 month time horizon. But the reason there's a little bit longer time horizon is because there's a little bit more risk, right? Where a money market fund can only invest out to 1 year in a single security. JPST can go out to 5 years, right? We don't do much in that 3 to 5 year space. Most of what we do is inside 1 year, again, that conservative DNA. But there is a little bit of interest rate risk. There is a little bit of credit risk. So in order for our clients to use the fund appropriately, we recommend that minimum 6 month time horizon. And that's how all of our models around managing the fund are built, right? And so we talk a lot about cash segmentation in our space, whether it's an institutional or retail client alike. You don't need to choose cash or ultra short. You don't need to choose ultra short or fixed income. It's really using all of them and sort of segmenting out based on your individual client needs.
Yeah, absolutely. So as we recently kind of entered into this new Fed campaign of cutting rates, right? And we've had some interesting dynamics in the with rates. With when they cut, the 10-year actually ticked up higher, right, and has moved higher since then. So, what are your thoughts on kind of where we find ourselves? How you think the market will react moving forward, and where should we be looking at, the yield curve and the best opportunities moving forward?
That's a great question. It's something that I probably talk about most often in my conversations with clients. I think it's clear that the Fed has embarked on a cutting rate journey, and we got 50 basis points up front. We obviously had last week a very strong labor report, and now where it was another 50 basis points priced in for November, it now looks like it's going to be 25 basis points. Frankly, I think we're going to toggle for the next year plus on how many interest rate cuts we get at each meeting until we get to a neutral rate of about 3 to 3.25%. And I do think we're going to get 25 basis points at each meeting remaining this year, right? So you get 100 basis points of total cuts this year. And then I think you're going to get about 100 basis points of total cuts next year. I don't think the Fed goes every single meeting, but I do think they want to keep their momentum going to get to that new neutral rate. And I'm not sure they know exactly where neutral is, to be honest.
Right.
And that's fine, right? I think they have to feel that out through their cutting rate cycle. I don't think neutral is where it was during the last deflationary cycle, 2010 to 2019. It was about 2.5%. I think it's somewhere in that three. I think it could be 3%. I think it could be 3.25%. I even think it could be 3.5%, depending on how inflation behaves over the next couple of years, right? The employment inflation dual mandate is extremely important here in terms of landing on where exactly the Fed finishes their cutting rate journey. But I think it's clear we're in a cutting rate cycle. And what happens in a cutting rate cycle is the front end of the curve, to answer your question directly, comes down precipitously, speaking to primarily that 1 year and in part of the curve. It's very clear to us there is still a lot of room for those pieces of the curve, 1 year at about 422, to come down, 6 months further out the curve, and in that 450 territory. The front end is going to come down significantly. As you start to step out the curve, 2s and 3s, I do expect to also come down as we approach a new neutral that's much lower. But as you step further out the curve to something like a 10-year, it becomes more uncertain, right? Because a 10-year is going to reflect the expectations over the next 10 years for Fed funds. And it's also going to reflect our fiscal deficit and what occurs there, which, as we know, is not a pretty picture. So the way I like to answer the question on where I see and where our group sees a 10-year is looking at history, right? From 1990 to 2020, the slope from the 3-month to the 10-year was on average anywhere from about 50 basis points to about 200 basis points. The reason I say that is because I do think we're going into a positively sloped environment. Our view is for expansion, and that will be accompanied by a positively sloped environment. I don't think the slope is going to be 20 basis points or 200 basis points, because we're not in the 1990s, much higher yield environment. I don't think the slope is going to be 50 basis points because we're not in the 2010s deflationary environment. But let's just say it settles at 75, 100 basis points, and the Fed settles at 3.25%. That puts a 10-year Treasury right around that 4% level, and I think it trades volatile around that level. So let's call it 350 to 450. Looking forward, as the 10-year and the long part of the curve finds its footing. I absolutely think the long part of the curve needs to be a part of duration, needs to be a part of portfolios, but it's going to be volatile because I think there's a lot of uncertainty as to what the picture looks like 2, 3, 5+ years down the road.
As the short end of the curve comes down, does that change the perspective you guys have managing a fund like JPST? Do you guys start to become more open to that 3 to 5 year area, or do you stay true to the 1 year and less for the most part?
So for us, it definitely pushes us longer, right? And I talked a little bit earlier about how JPST is a money market instrument corporate bond hybrid, right? 2022, we looked more like a money market fund. We wanted to hold more money market instruments. Rates were rising very quickly. The fund did very well, looking more like a money market fund. Today, we want to look more like a corporate bond fund, right? Corporate bonds are issued 1 year and out because we want to have a little bit of duration on. Our models tell us that adding duration at the 1 year, at the 2 year, at the 3 year is going to be additive to performance over a money market fund or a 3-month T-bill roll strategy, which ultimately is our goal, to outperform that type of strategy over a cycle. So yes, we're adding duration. In the 3 to 5 year part of the curve, we never have done very much just because of our MO as a more conservative manager. We'll do a little bit, a few percentage points, but not much. The way we're approaching the portfolio today is we're adding primarily around that 1 year point in the curve, which is technically overweight duration for something like an ultra short fund. And then we're opportunistically adding out the curve, more at the 2 and 3 year points on the curve. And that gets us to a duration around a 0.65 year, which is a mild overweight. A money market fund has a duration of about 1/10 of a year. So when I look at where we are today, it's mildly overweight. We're not fully overweight because of that variety of scenarios that we could see for the neutral rate. If the Fed does end up at 350 neutral, something like a 2 and a 3 year bond is not going to do very well, right? So I don't think that's our base case by any means, but it's certainly a plausible scenario. Call it maybe a 10 or 20% scenario. So that pushes us more mild overweight than heavily overweight in duration because of that particular scenario, which again, I think is fairly plausible. So long way of answering the question in that, yes, we like duration in a time like today. And we've seen that over time in past cutting rate cycles, adding duration in this space provides a big tailwind to performance, again, over money market funds and T-bills.
Sure.
In your opinion, has Chairman Powell and his team, done a good job? Are there any risk that you see that is facing the Federal Reserve as we begin this rate cutting campaign?
It's a good question. I think the Fed was late in raising rates, which we all know. We went through the time period of calling inflation transitory.
Right.
We can look back now and say that a lot of it was transitory, right? It was supply chain issues, and then now we're looking at auto insurance and hospital insurance, which is lagged, but also ties back to the pandemic, right? And now we're seeing inflation at 2%, but I don't think 2.5%. I don't think we would have got there without the Fed raising rates. They did it. They just did it a little bit late. I think the way they're approaching the market right now makes a lot of sense. So I don't, maybe they're a hair late, which is why they went 50 basis points instead of 25. But I don't think it's going to tip the economy necessarily into a recession based on what we see right now. There's some negative things in the economy, but in our opinion, there's far more positive things in the economy to keep this expansion going. So I think the way the Fed has laid out their initiatives, laid out the cutting cycle, now makes a lot of sense. Looked a little bit different 2 years ago, but I do agree with the way they're approaching the market now. And not necessarily, it was impressive the way they got 50 basis points under their belt without rocking the boat, right? That was what we were considering in early September and late August was, well, if they go 50 basis points, is the market going to get spooked? But there was enough Fed speak out there before the dark period. There was some articles during the blackout period, even from the Wall Street Journal, talking about the likelihood of a 50 basis point cut, and essentially the market was unimpacted. So no, I do like the way that they're approaching the marketplace today, going forward into this cycle.
You kind of touched on it real briefly, but what are your 20,000 foot views on the overall economy as we're now into it, beginning of the fourth quarter, and then as we move into the new year? What are your general thoughts on the U.S. economy?
Yeah, good question. I listened to your episode a couple episodes ago on soft landing, and that was the title of the episode. That's our expectation, is for soft landing and expansion with about an 80% probability, right? So it's not, we can't discount recession. I think there are enough things going on in the economy that makes a recession possible over the next 6 to 9 months. We look at the wars that are going on abroad. If, like you said on your episode, if one thing goes wrong that makes this contagious even to broader Europe, I think it could rock markets quite a bit. When I look more into the U.S. markets, yes, we have the first thing we're looking at right now is delinquencies in credit card data. And let's just start with the negative, and then I'll go to the positive. The negative, delinquencies in credit card data, it has been primarily in the non-prime cohort, so the lower credit scores, which is not going to drive as much spending in the economy. Also, when we look at the total loss data at this point, it looks healthy. And when we look at all the data in aggregate, in terms of looking at credit card data, it sort of looks like a more normalized level to where we were pre-pandemic. So we're not concerned necessarily at this point with credit card data. But what's happened is inflation has built up quite a bit, right? And we always look at that year over year number. But if you look at the price of a basket of groceries today versus 3 years ago, it's not 2.5% higher. Right. It's 25%.
Yeah, the cumulative effect.
And that's going to weigh on the economy and on the consumer, and that's something that we need to take into consideration, which is why we have some positive probability for recession. The other negative that I would point out is manufacturing surveys in that contractionary territory. I'm not concerned because this is more of a services-driven economy, and we are comfortably in an expansionary territory on those particular surveys. So that's sort of the things we have our eyes on in terms of the bad. In terms of the good, I think it outweighs the bad, right? When we think about the consumer, they've been spending healthily. When we think about wage growth at about 4% and sort of stabilized now after looking at the last employment report, it's above where inflation is. So in our opinion, that equation should allow the consumer to get through this inflationary period, to get through and allow us to continue to expand. On the corporate side, we have profit margins near all-time highs, right? Around 18, 19, 20%. And then we look at capital spending, which is very high given the AI boom that we've had and that we expect to continue to provide a tailwind to the economy. So our view is, that's our top-down view. Take a step back. Going to be around trend growth looking forward. I think we're still in a high enough interest rate period where you may get sub-trend growth, meaning a 1.5 or 2% GDP growth instead of a 2.5% GDP growth. But as I look out more intermediate term, I do think AI is going to provide a productivity boom, and I think that can allow for above trend growth. So we have a relatively rosy view on the economy, and we're positioned as such in our portfolios.
Real quick question as we kind of wrap up. So there's a record amount of assets in money market funds, right? I know JPST is not technically a money market fund, but a next best thing, I guess, the closest thing to it, right? So when you look at the flows that we've seen into money market funds, ultra short funds, do you guys view that as, and I've heard differing opinions on this, right, which is why I want to ask you the question. You hear the kind of dry powder conversation of like, well, this is money that's ready to get into the market, that's just sitting there, and like, at the right time, we'll start to see money move out of that. My personal opinion is that's not necessarily the case. That money is going to be stickier than those people think. But, interested to get your views on how you guys see that.
Yeah, really good question. Something we look very deeply into, and I certainly have a view on. I do think the lion's share of it is sticky, and the lion's share of it is institutional money. I talk to these institutions every day. This is operational money that is sitting and that needs to be in these money market funds to be used, to be drawn on a regular basis. You just have to look at the growth in the economy. I mean, the growth in the economy over the last 5 years has been tremendous.
Right.
Growth in money market funds over the last 5 years has been tremendous. When I look at the retail side of the equation, I think a fair amount of that is sticky as well. I think clients are comfortable with where they are in terms of money market fund yields, still in the high fours. And so I think a good portion of that is sticky as well for clients who need cash, for clients who are comfortable in cash, understanding that first step out is not cash. Now, looking at history, what we see during cutting rate cycles is typically you do not start to see any sort of money market fund outflows until the 3-month to 2-year part of the curve uninverts. Okay, and that does not happen until typically 3 to 6 months after the first cut. Now, that would put us into the earlier part of next year, and I think if we see money market fund outflows at all, it's going to be next year. There's a seasonal argument to that as well. Money market funds see a tremendous amount of inflow in the fourth quarter due to seasonal inflows, accounting reasons. So our view is you may see a little bit of outflow in the first and second quarter next year, but by no means is it going to be open the floodgates out of money market funds. Money market funds are $6.5 trillion. Right. Maybe you see a few $100 billion trickle out.
Yeah, I think when you see that $6.5 trillion just figure, it's kind of shocking, right? That's a lot of money. But when you look at, like you mentioned, you look at the overall economy, the growth, the total market capitalization and where it's at now relative, it's actually not too out of line with historical money market, how much funds are in money market funds. It's just everything's grown, including money market balances.
What's your percentage?
Exactly right.
What's your percentage in JPST between institutional and retail?
Yeah, that's a tough one to zero in on, other than sort of the graphs that I have on the conversations I have and some of the public filings that we see that list some of the largest holders. I would say roughly 80-20 retail to institutional. We definitely have institutional clients, and those clients became a bigger portion of the fund as the fund grew to a larger size, and we've had more of those conversations in the last few years than we had the first few years. But it is the lion's share, especially if you look at the public holdings, are large retail clients.
And I think that as we wrap up, I think that it'll be in the retail space where you see some of that money go out because they're using it as
the curve.
Yeah.
Well, I was just looking at Y charts here. It looks like JPST has a little over $26 billion in assets with almost $2 billion worth of flows in the past year. I don't know how accurate that data is, but that's just according to Y charts. So congrats to you guys. Great product, great strategy, and hopefully you guys continue to see that kind of success.
Thank you. Yeah, and just a bit on that quickly. A couple billion over the last year, but most of that inflow has actually come in the last 2 quarters. So we're up about 4 billion year to date, and this is as the Fed has embarked on their cutting rate cycle, their cutting rate journey. Clients are starting to step out the curve. We're having a lot of conversations about outperforming in this first step out of cash type of product. So we've seen a tremendous amount of momentum in the last 2 quarters, and we've started to see that in the fourth quarter as well.
Yeah.
A few days in already.
That's awesome.
We didn't bring this up in your introduction, but I find it kind of humorous. Jason kind of alerted us to the fact that your name is actually Alexander, correct? Goes by AJ.
That's right.
His wife's name is Alexandria. And I understand probably some email confusions often exist.
I'm Alexander Noble. My wife is Alexandra Noble. We both work in JPMorgan Asset Management, and we get emails crossed all the time. So that's always that's typically my fun fact. It's kind of funny that that's the case. We certainly, Alex and Alex, our firstborn was a boy. His middle name is Alex. His first name is not Alex.
Cover both bases there.
That's hilarious.
Yes.
Well, man, we appreciate you jumping on this Tuesday morning with us. We appreciate it very much.
Yeah. Any final thoughts or parting words of wisdom?
No, thank you both for having me. I think thinking about the ultra short space, I think it's a really great opportunity right now, given where money market fund rates are and are expected to go. Just taking a little bit of duration can give clients some comfortability in outperforming cash without stepping too far out the curve. I think it's a message we've been leading with recently.
Yeah.
Well,
awesome.
we like it. Our clients like it. So we'll continue there.
Yeah. Well, like Lee said, we appreciate you joining us. Thank you, everybody, for watching and listening. Give us a like, subscribe, comment, and we will look forward to seeing you guys next week.
Have a great week.